Mm, mm, mm. Emotional decision for them. It's a monetary one, but it's an emotional one. It has to deal with their health and their families as well. What are they saying to you?
Yeah, absolutely. It is very emotional. And you try to meet emotion with practicality, right? You try to bring facts into circumstances that are otherwise engulfed in worry. And we tend to think that's where planning, one of the values that planning provides, is it kind of provides and delivers some context relative to the decision-making process. So some of those questions, I mean, what if there's a season? What if there's not a season? What if a player opts out? What if they don't opt out? What if they're high risk? What if they're not? What impact does missing a credited season have? What about repaying the stipend? Do I have to do it? What happens to my guaranteed money? What about the non-guaranteed money? What if you go into the season and it's and it's canceled mid-season, what impact does that have for guaranteed versus non-guaranteed money? And so to your question, like the players are coming in and their wives are coming in and they have those questions and they have the associated emotion inherent to those questions. And so what we do is we say, hey, all right, deep breath, let's go into the planning process and let's walk through your plan. And what we have the capability to do as global sports and entertainment directors at Morgan Stanley is stress test allocations and run what if scenarios. So it's not enough to just have a plan. You have to have a plan that kind of incorporates different what if scenarios. And you have to have the ability to stress test those scenarios relative to their ability to come to fruition. And when you do that, and you kind of come in and you say, well, if this happens and that happens, you have a circumstance that has modified your plan from, say, a 93 probability of likelihood to, say, an 85% probability of likelihood, just making up numbers here, right? And to the extent that's the case, then we've delivered kind of practical, quantifiable context to an otherwise an emotional moment. And it gives them the ability to make a more informed decision as to what course they want to take. I mean, is that remarkably nerdy? I mean, absolutely, right? But it does bring some context and some clarity and some kind of quantifiable, measurable potential impact to a situation that's otherwise kind of engulfed in a wall of worry.
Mason, about 30 seconds left. I remember talking to some PGA Tour players last year, and I asked them off camera, what are you investing in? Their common answer, I don't know. I have someone who handles that. Are these players showing more interest in their money, and what's your best investment tip to them right now? So many of them invested in real estate, but that's a big ticket purchase, costs a lot of money up front.
Yeah, so I understand that, and I'm a longtime member of the PGA of America myself, so I appreciate that question. You know, players should be reminded that they are a business, right? And to the extent that they can invest within themselves, the time, the dedication, the discipline, the resources, financial and otherwise, into their own journey, then they're going to be well prepared. And so that involves managing cash flow, living low to the ground, saving aggressively, and investing with prudence. To the extent that they can do that, right, especially the save aggressively part, right, and then they're going to be better off for it. They're going to be able to weigh their investments within their allocation from the perspective of not chasing a fast buck, but rather making a prudent and well-informed investment decision.
All right, let's leave it there. Mason Champion, financial advisor at Morgan Stanley. Good luck on the links this weekend.
Hey, thank you so much.
All right, let's get back to Inez Ferre for another look at the markets. Inez?
And Brian, we're watching Alphabet and Google today, or Alphabet and Apple, so I should say. Epic Games, the creator of the very wildly popular online game Fortnite, has sued Apple and Alphabet's Google for removing its game from the app stores. It all started when Epic announced a discount for players not using Apple or Google's payment systems, and Apple and Google then kicked the game off the App Store and Google Play for what the companies call a violation of guidelines. Now, Epic's post had noted that Apple and Google app stores take a 30% cut of in-app sales, and Epic CEO Tim Sweeney has criticized in the past both companies for these practices that he calls anti-competitive. And then just looking at Vivint Smart Home, that stock is down about 1% despite a price target increase at JP Morgan, with JP Morgan's Paul Coster reiterating an overweight rating, saying that Vivint has a meaningful leadership position in the smart home and home security front. Brian?
All right, sounds bullish to me. Inez Ferre, thanks so much. All right, up next, a big Friday show for On the Move. They'll speak with DraftKings CEO Jason Robbins on what a full fall without college football means for one of the country's largest sports betting sites, and they'll chat with Master P on the future of the music industry. Wow, Master P, I remember listening to him in the back of my 87 Monte Carlo Chevrolet SS. And no doubt, of course, you'll get all the analysis on the midday market moves. Do stick around. On the Move is coming up next.
And welcome to Yahoo Finance on the Move. It is 11 a.m. here in New York City, 90 minutes into the trading session, and the Dow is off about 20 points. S&P 500 almost flat, down roughly 3 points. Nasdaq is off about 0.5%, down roughly 50 points. Some of the headlines moving these markets right now: a retail rebound. Sales rose in July above pre-pandemic levels in a sign the economy continues to heal from the recession. Place your bets. DraftKings beat revenue expectations in the second quarter, but will the momentum last without college football? The CEO will join us straight ahead. Plus, an historic pick. Kamala Harris became the first Black woman in history on a major party presidential ticket. We're going to speak with civil rights leader, the Reverend Jesse Jackson, and get his insight into that historic move as well as this election in just a few minutes. Welcome to On the Move. I'm Adam Shapiro along with Julie Hyman. Joining us this hour on the panel are Dan Roberts and Akiko Fujita. Let's have some fun. And let's start with Emily McCormick to talk about the retail sales numbers. Some good news there, maybe a few red flags. Give us the breakdown.
Well, Adam, taking a look at the Commerce Department's retail sales report from this morning, it showed retail sales did rise for a third straight month in July, but lost some steam, especially compared to that record jump that we saw back in May. So headline retail sales rose 1.2% in July, month over month. That missed consensus estimates for a 2.1% jump. However, retail sales are now back up on a year-over-year basis by 2.7% after a few months of decreases on this basis, especially after that record decline that we saw back in April. Now, taking a look by category, we had electronics and appliance sales up nearly 23% in July for the biggest jump of any category. We saw gas stations and miscellaneous store retailers both rising by 6.2% month on month. Now, taking a look at clothing stores and food service retailers, those extended their June gains, but at a slower rate. Sales at those stores were up 5.7% and 5% respectively. Now, on the flip side, I want to take a look at sporting goods and hobby store sales. Those were down 5% in July for the biggest decrease of any category. This was followed by a 2.9% drop in sales at building material and supply dealers and a 1.2% drop in motor vehicle and parts dealers. Now, when we exclude some of those more volatile categories, including auto and gas sales, retail sales did rise by a better than expected 1.5% in July. That was versus the 1% gain that had been expected, but still this was a deceleration from the 7.7% gain of that metric that we saw back in June. So overall here, still seeing an extended rebound in retail sales, but at a slightly slower pace than had been expected for that broadest metric of this unit. Adam?
Let's talk about what this means for the economic outlook. And to help us do that is Jason Ware, Albion Financial Group partner and CIO, joining us from Salt Lake City, Utah. Always good to see you, Jason. And I'm curious, what do you make of these numbers, especially since you believe this economy is being propped up by policy support and scientific development?
Good morning, Adam. I think the retail numbers are to be expected. They shouldn't surprise anyone. You can't continue to have the pace of growth that we saw in May and June continue forever. I think we had a pretty sharp snapback in the late spring, early summer, and that this number corresponds with a number of other data points that suggest that the economy has slowed a little bit here into midsummer on the back of some areas in the country having to slow down their reopenings again. Not terribly surprising, but I think we're still moving in the right direction, which is positive.
Jason, it's Julie here. Good to see you. So when we talk about the momentum of the economic recovery, of course, a big factor that's been talked about is whether people are going to continue to get stimulus checks. How large will they be for how long? And one has to wonder about the sustainability of a retail sales rebound, not just the size of it, the magnitude, but also just that it will keep going if the stimulus checks do not. How concerned are you about that? And are you sort of holding back on any of your bets in the market until we see the outcome of that situation?
Yeah, it's a really great question, Julie, because, at the end of the day, we've seen consumption drop during the pandemic, but we've seen incomes rise, which has been kind of a strange dichotomy for a recession, and in part because of the policy support that has been provided by Congress. So, as you noted, the additional allotment from the federal government has run out. It doesn't seem like Congress is doing their job in trying to swiftly remedy that by getting those who need it the income supplement to get through this pandemic. So I think that certainly opens up a hole in the economy economy if lawmakers don't come together quickly to supply that extra amount of money. We will see incomes take a step down in the third quarter if they don't extend that in some way. I mean, the Democrats would like to see $600 a week extended. The Republicans are a lot more austere than that. And we're at a stalemate. So we do need to see that pick back up. We also need to see real job growth continue to recover as well. And I think if we get that, and our expectation is that we will get both. We think the labor market is healing slowly, and we do think that Congress will do what's necessary. It's just unfortunately going to be a frustrating process to watch. And I think that things will be okay as we get into the back half of the year.
When you talk about supportive policy that's needed to keep this momentum going, how much support are we talking about? I mean, we're talking about $600 versus $300 that Republicans are talking about. Is that enough to keep this going?
So we saw in the first round, $600 was enough. In fact, that replaced incomes for many above what they were making, at their jobs. So I think $600 is a generous allotment, and we would celebrate another $600 policy for these individuals, because we are in very unprecedented times, and that kind of support I think is required given the hole in the economy that the pandemic has opened up. I mean, this is more like a natural disaster than a traditional type of recession. So these individuals that are out of work, and there's about 16 million of them that still are 13 to 16 million lower than we were prior to the pandemic, that need some kind of income support. $300 that the Republicans are pitching seems a little bit thin in our view. I think, again, that will certainly result in a slowdown in spending. So we'd like to see something closer to $500-600, and we think that's necessary given where we are in the economy and given what we're facing still.
Jason, Dan Roberts here. If we circle back to the retail number from this morning just for a moment, obviously, even though it didn't meet expectations, at least spending rose for the third straight month. And I'm just curious, Can we take this data along with, I guess, the most recent unemployment data as a sign that things troughed in May? It seems like we kind of bottomed in May. Obviously, that could change with new cases. But where do you see that in terms of, as we look through the next few months, are things going to continue to get better, even if some months, the getting better happens more slowly?
Yeah. So, our view is that the economy did bottom in the spring. We're seeing earnings now bottom in Q2. So I think the path of least resistance is probably higher as we look out over the near and medium term. Like to your point, progress is not going to be straight up. There are going to be some setbacks. It's going to be a little bit slower in the next few months than it was in the prior couple of months. And that's just because that initial part of a V recovery is always going to be a little bit sharper early on before it starts to level off. So a little bit more of a square root or a Nike swoosh, as people have been calling these different recovery shapes, I think is something that can be expected. But I think that's okay as well. We don't have to, get back to a 3 or 4% economic growth to see progress and to be optimistic about where things are going. And we don't need that kind of growth for the stock market to continue to move higher as well. I think it's just the progress toward things improving and healing that's most important. And I think on the scientific front, we have some therapies coming this fall that could be helpful toward getting more people out into the economy and getting activity back up. And of course, a vaccine, hopefully in early 2021, which is our current view, I think would also support that as well.
Jason, we're going to talk about vaccines in just a minute, but very quickly, is there, as the saying goes, a rational exuberance for those who are getting into the market right now, especially with Goldman's note about the S&P 500 potentially hitting 3,600?
I think if you have a long-term time horizon, there's never a bad time to invest in the stock market. I think if you're looking out over the next couple of months, it's really hard to say where the market's going to go. But if you've got a 3, 5, 10-year plus time horizon, having a portfolio of good companies, well diversified, and having a good asset allocation and a smart financial plan is always the best bet for most investors. And we continue to think that the market's path of least resistance is higher right now. And I think as we look out over the medium and long term, we're still optimistic on owning a cross section of U.S. companies.
Okay, Jason Ware is the Albion Financial Group partner and CIO from Salt Lake City. Always good to see you, Jason. He mentioned vaccines and what we expect to happen in the fall, hopefully a vaccine that will work. We spoke to Johnson & Johnson's Chief Scientific Officer, Dr. Paul Stoffels, yesterday. Here's some of what he told us.
The one question we now need to answer is, does it protect for disease or does it protect also for transmission? And that's the one, so we are reasonably comfortable that we get to a vaccine, and hopefully we don't have to throw away the billion vaccines we made.
All right, let's bring in Angelique Kemlani to tell us the latest on where we stand in our vaccine checkup.
Thanks, Adam. So right now what we're looking at is a number of deals that have either been announced or will be announced or are in the works right now. And that, as we know, is one of the biggest obstacles that some of these vaccine producers do face right now. So as of right now, we know that Johnson & Johnson is in talks for a $200 million 200 million dose deal with the European Union and has already announced today that they will be providing 30 million doses to the UK, as well as collaborating on phase 3. Meanwhile, AstraZeneca right now also in a deal with the EU for 400 million doses, and Novavax out with 60 million doses with the UK. Now, by comparison, these companies are also promising doses to the US, AstraZeneca with 300 million, and Novavax with 100, and Johnson & Johnson with 100. And it's very interesting to see these promises of these doses out there, because we know that depending on what sort of technology they're using, whether it's heat stable or needs refrigeration, there are going to be further issues when it comes to how do they respond to this outbreak with this unprecedented demand that we're seeing globally. And all these promises of vaccines to the Western world has really stirred some controversy and some concerns about what the availability of vaccines will be in other parts of the world, including African countries, Asian countries, and South America. So lower income countries are a major concern right now.
Anjali, thank you very much. Just want to point out that we have in the United States 5.3 million of our fellow citizens who have tested positive for this virus. We're going to turn our attention now to the Reverend Jesse Jackson Sr. He is, as you know, not only an international figure and the head of the Rainbow Push Coalition, but he's a civil rights leader who has helped create the world we all live in right now. And it is such a pleasure to bring the Reverend Jesse Jackson to our program on a week where history has been made. Reverend Jackson, good to see you.
Good to see you, sir.
So let me begin with this. It has been 60 years since you were first arrested for taking part in a sit-in against a segregated library in Greenville, South Carolina. Where we are today, Kamala Harris on the ticket of a major party. When you look at the progress that has been made and where we have yet to go, what do you want us to know?
We've come a long way since that time. Then Dr. King and John Lewis spoke in Washington in '63. One black liquor Christian all in the whole South, Leroy Johnson, Atlanta. One black in the whole South.
Oh, did we just lose Reverend Jackson? I think we have lost Reverend Jackson. I'll tell you what, we're going to try and get the Reverend Jesse Jackson back into the stream in just a bit. But right now we will take a break because we want to hear what he has to say. As we deal with that technical issue, let me take you to some stocks which are on the move right now, because these markets, as we have talked about, are trying to go positive. But then there's the Novavax. Shares are up about 8% at the opening bell. The United Kingdom signed a deal for an additional 60 million doses. They received $1.6 billion from U.S. taxpayers, as you might recall, and their recent study of their vaccine showed that it created high levels of antibodies in 56 people. Just 1 month, that stock is up 38%. We're counting on Novavax, but remember, they have never in their almost 40 years in business brought a vaccine to market. Then there's NIO. This is the competitor to Tesla, the Chinese electric vehicle manufacturer. Shares down about 5% at the opening bell. Their earnings reported earlier this week. Some improvement. They tripled vehicle delivery. Now let's put that into context. They went from 3,000 to about 10,000 vehicles. They had a smaller loss than expected, so they're creeping toward profitability. 1 month, that stock is down about 8%. We're going to have more on the move for you right after this. There is an epic battle, pun intended, between Epic Games and Apple, and perhaps eventually Google, that is forming. But right now we have Apple, which kicked Fortnite out of its app system because of payment issues. And then Epic Games, which is the owner and maker of Fortnite, has filed a lawsuit against Apple. Let's break all of this down and start with Dan Roberts. I mean, this is a battle of some Goliaths, isn't it?
Yeah, it's really interesting, Adam. Look, the App Store has been under fire for a while now, but with Fortnite joining the fray and Epic Games, I think it really brings the story much more to the fore. Now, remember at the DC hearings with the big four tech names 2 weeks ago, the subject of the day was supposed to be antitrust, but in a way, I think a lot of people walked away from it feeling that Apple got off the easiest, got sort of the fewest, easiest questions. There are more obvious ways that lawmakers, if they ever really do this, would be able to go after, say, Facebook and Google. There are obvious acquisitions those two companies have made that you could see lawmakers saying you have to spin those out. Apple, not so much, not as clear, but then you have the App Store issue, which is almost a separate example and is becoming more of a problem optics-wise. Now, I don't know that that means that, you know, lawmakers can really go after it. First, they'd have to actually understand it, but it sure looks like a monopoly. I mean, getting those 30% fees from every app and for in-app purchases. And now, of course, just 2 weeks ago, we had the very popular new email app, Hey, H-E-Y. They were making the same complaints. Of course, when Fortnite comes along and does it, it makes it much more of a story. And what's interesting and different about what Epic Games did is it very much knew what it was doing and aggressively kind of took a shot by having users able to make in-app purchases and get a discount on them by bypassing the Apple system. So they knew what they were doing. It was a shot across the bow. They were kicked out not only of the Apple App Store, but Google's App Store. And we're going to see what happens here. Now, if you ask me, though, do I bet that actually Apple is going to, you know, have some kind of challenge to the App Store? I mean, other than this lawsuit, or lawmakers going to understand how to go after it? I don't know. I think it's not great optics, but I don't know that anything's going to change because a lot of apps for years have just accepted that this App Store fee is the price of doing business.
Yeah, I mean, to be clear, Fortnite got kicked off because they did explicitly violate the rules in place for Google Play as well as the Apple App Store, which essentially says that you've got to go through the in-app or the store's billing method. And so Fortnite is in a position where they can do this, to Dan's point. But, you know, I think the question is going to be not necessarily the court ruling so much as it is how many other companies jump on board here. There's not a lot of companies that can do this in a strong financial position. You know, does Fortnite set the trend? I think that's the thing we have to look for moving forward.
Okay. I have some good news too, by the way. We have reestablished the technical connection with the Reverend Jesse Jackson. When we come back from the commercial break, we are going to touch base with him about the historic movement today or this week with Kamala Harris and where the country goes afterward. And welcome back to Yahoo Finance on the Move. We have reestablished the connection with Chicago and the Reverend Jesse Jackson. And sir, I wanted to ask you, what's the next step in the push for equality in our country? Is it political? Is it corporate? Because the historic potential nomination of Kamala Harris to be the vice presidential candidate on a major party ticket is only one part of this, correct?
She's so superbly qualified. Think about her being the Attorney General of the state of California. Same on as the Department of Justice in Washington. She's superbly qualified as a very trained. She could have been the Attorney General. She could have been on the Supreme Court. She's superbly qualified. And that's very impressive. I watched how when I ran in 84, I saw a black man in the White House one day. We kept pressing the case. In 84, 08, it happened. I said, a woman, if India Gandhi can guide India, if Golda Meir can guide Israel, if Miss May can guide Britain, why can a woman be on the ticket? Ferrara came out of that. We've advanced a lot since that time. I'm glad that Cameron is the right person. On a scale of 10, Joe Biden hit the 12.
Reverend, it's Julie Hyman here. Thank you for joining us. It's good to see you. So as we look at this pick of Kamala Harris, as we look at where we are with the Black Lives Matter movement, you have been at this for a long time. So where do you think we are at this stage with this resurgence of activism that we have seen and this long journey that you have been on, if you could sort of assess this moment in time?
President Barack being up top and Kamala being up top represents our aspiration. The infrastructure, what the real deal is, ultimately. The point is that the health gap is distressingly wide. Education gap, wage gap, capital gap. So we must now beyond. The thing I like about Black Lives Matter, it's not limited to blacks only. The thing about the protests in Portland, it's not about blacks per se, it's school of thought. You think about the mayor of Denver, still less than 10% black, he's the mayor. The mayor of San Francisco, less than 5% black, she's the mayor. We begin to learn how to vote together. And it's about direction, not just complexion. That's real growth.
Reverend, there's no question Kamala Harris, as the VP pick, has not only mobilized the Black community, but the Indian American community as well. And yet we are still seeing voter suppression tactics being put forward to try and silence the votes of especially Black and brown communities. You heard from the president yesterday essentially admitting to that, saying he didn't want to fund the U.S. Postal Service because the Democrats wanted to expand mail-in voting. How do you counter that message? What needs to be done in the next few months to ensure that you can mobilize these communities, that their votes do matter?
Closing down the post office is not for blacks only. The idea of using the post office as a tool to undercut access to the ballot. The president giving his Republican national address at the White House. It's a level of tyranny we've never known before. I think all of America must make a choice, followed by hope and not backwards by fear. I think that the suppression tactics of the Republicans, when the mail-in is one issue, sending lines, we're determined to vote nonetheless.
Reverend, I'm curious, you know world leaders, you know past presidents. Have you ever had a chance during the last 3 years to speak to President Trump? And if you have, what did you talk about? If not, what would you say to him today?
In 1999, we began the Wall Street Project in New York, and President Clinton was the co-chair, and Donald Trump came with him. He'd be rather typical businessman, liberal type. We argued no black at that time had done $1 billion. That offer we had no real place on Wall Street that was superbly qualified. He seemed rather normal, but then the issue of the Central Park 5, the birth, he just got deeper and deeper. Charlottesville. He is not who he was when we first met him, in my judgment.
All right.
Reverend, if I could also ask about your work in the corporate world, because I know you've been quite active pushing for change at American companies. And it seems like lately, increasingly, they have been hearing that. They have been trying to increase diversity on corporate boards. What do you think the top priority needs to be for corporate America right now when it comes to diversity?
remove the racial and gender barrier and let the market speak for it. We were doing well on the football field, playing field even. Rules public, goals to referee, fans, was transparent. It does not apply beyond the football field. The blacks and browns qualified to be effective marketers on Wall Street. We went to Silicon Valley 4 years ago. There were 3 blacks and 36 women on boards. Now there are 27 blacks. We're seeing pressure and progress, and we must keep applying the pressure. I'm glad to see a day when all the shots that the Trump are taking at Kamala, like snowball on a hot stove, it doesn't sit because she's so qualified. And that's a good thing.
The Reverend Jesse Jackson is not only the founder and leader of the Rainbow Push Coalition, but you've helped create the world along with the men and women who were on the front lines of the civil rights movement. You've created the better world in which we all live, and we appreciate it. Thank you, Reverend Jackson. We'll be right back.
Thank you, sir.
And welcome back to Yahoo Finance on the Move. I'm Adam Shapiro along with Julie Hyman. We're watching shares of Facebook right now. They're off about 0.5%, but we want to let you know that the Dow and the S&P 500 have moved into positive territory. NASDAQ is still trying to do that. The reason I bring up Facebook is they've announced a new program to potentially safeguard the news and information that is shared on the platform. And to help us understand what this is about, we welcome into the stream Nathaniel Gleischer. He is Facebook's head of security. Thank you for joining us today.
Thanks for having me.
So let me start with this, and I'm going to use an example that reared its head yesterday afternoon. We have the President of the United States and members of the administration refusing to knock down what is clearly a false bit of news that Kamala Harris may not be eligible to be on the ticket. We know she was born in Oakland, and yet birtherism has reared its head. What does Facebook do when people start sharing articles about that which are clearly inaccurate?
Whenever there's a piece of content on our platform that a third-party fact checker determines is false, we work with a broad network of independent fact checkers for just this purpose. We will label that content very prominently. For example, if it's a video, there's actually a label across the video that you have to click through before you see the video. And then we'll also downrank that content, so far fewer people will see it. What that means is that no one stumbles across these videos or this content once it's been labeled as false. And if someone is hunting for it, which as we know on the internet, they will find that content somewhere if they're looking for it, when they do find it on our platform, it has a clear label on it indicating that it's false and a link to a fact checker who's analyzed what's being asserted in that video.
So who are the broad fact checkers? You hire them, you pick them. How do you screen them, and what do you do to stay on top of making sure that they're doing the job you want?
So we work with independent fact-checking organizations, all of whom are certified through the Pointer system. All of whom are certified through the Pointer system. There's a wide range. So Associated Press, Agence France Presse, a broad range of fact checkers, all of whom are listed publicly. And every single one is certified by this independent organization. So we use that framework to ensure that we're getting neutral and independent fact checkers to do this assessment.
Nathaniel, I think we can all anecdotally say it hasn't worked terribly well, and I won't limit that just to Facebook. By the way, I think in general we see misinformation spreading far and wide, despite what the social media networks have said are their best efforts. So, what can you do differently, I guess, is the question, to shut this down in more decided fashion? Because I think all of us have seen this stuff, even though you're taking these measures that you're talking about.
And I think the question of misinformation in public debate today, it's a very big challenge beyond the social media platforms. I know I'm sure you struggle too with how you cover bald-faced false claims and give the public the right amount of context around it so that they can hear the claim, but also understand the context for the claim. These fact check labels are one piece of our approach, but I want to pull back a little bit. My focus is on the security challenges we face. And in particular, we found, you're asking what we can do differently, it's really important to focus on the threat actors, the actors who are trying to target public debate and manipulate it. This type of content-based approach is one piece of the puzzle and one piece of the strategy. But if you only focus on content, that's not going to be enough by itself.
Nathaniel,
Another
who are
thing,
the threat actors? Who are they? Are they Russia? Are they China? Or are they within our borders?
Oh, that's a great question. And I would say that there are foreign actors and domestic actors. So whenever we find a network of deceptive behavior that's targeting public debate, we announce it publicly, we share information about it with third-party researchers, and we provide details on it.
Are they foreign governments, though? Can you identify them? It's Russia, it's China.
Absolutely. No, absolutely. So we've announced all of these publicly. We've announced so far this year networks from Russia, networks from Iran. We've announced a number of domestic networks, including from political actors right here in the United States and many other governments around the world. You can find all of these on our newsroom, where we detail what we've seen and the analysis of what they've tried to do. The tactics these actors are using is shifting. So what Russia did in 2016 was use large networks of very prominent fake accounts to try to push fake narratives. That doesn't work as well today, because the teams that are trying to find them and expose them at Facebook, at Google, at Twitter, in government, and in civil society are much better at finding those networks. So we're finding particularly foreign government actors, instead they try to use much smaller, much subtler networks that are harder to find. Now, what's interesting here, a good example of this, is an operation called Operation Secondary Infection, which our teams exposed late last year. It was a Russian-backed operation, the best hidden network of its kind that I've ever seen. But they were still found, they were still caught and exposed, and they didn't get much attention. And the reason is, if you're running a small network that's hidden so it won't get caught, you're running a small network that doesn't get that much attention. And the goal of these networks is to get attention. So the intent here is to force these actors to make a really hard choice. They can run a big, large network that'll get caught quickly, or they can run a small network that will still get caught and that won't get that much attention. That kind of trade-off is a difficult place for them to be. They're going to keep trying, and we've seen them keep trying. But pushing them in that direction is a good sign, and that's the type of goal that all the teams working on this are focused on.
And Nathaniel, I think the fear is, when it comes to cybersecurity, that the next phase of what they're doing is something you don't see yet, that you're not detecting yet. And so what might that look like? And from a consumer I guess from a consumer perspective, you don't really know, but from Facebook's security perspective, one would imagine sort of a straightforward hack is almost less of a concern than these more insidious methods that you're talking about. So what's the next generation then? If it's not this small versus big dichotomy, surely they must be getting more creative.
So one of the things we've seen them do is start directly targeting reporters. So as it's harder for them to amplify narratives themselves, they try to trick reporters into doing their amplification for them. We saw a set of Iranian actors use false identities to get op-eds and letters to the editor into a string of real newspapers in the United States. And we've seen Russian actors directly target reporters, sort of pushing false stories in hopes that they'll get covered. This happened around the 2018 midterms. And there's a good story there. The reporters that they reached out to were too smart to get tricked. And the teams that were working to protect the election were able to give enough context and provide enough context about what was happening that the reporter did write a story. And the story was Russian actors are pushing false narratives. But your broader point.
Make the broader point, and then I have a question about what you're doing to help us all find our polling places.
Sure. The broader point that I think is important here is for all the threats that we're prepared for, there will be many threats we haven't thought of yet. And we know that these threat actors will come up with new techniques. So we run red team exercises inside Facebook and with our partners in industry. We actually just a couple of days ago met with government partners and tech companies to talk about the types of threats we're seeing. And all the tech companies have rapid response teams set up. So when the thing happens we haven't thought of yet, we can pivot very quickly to deal with it, working with our government partners and working with our civil society partners.
Lastly, part of this new initiative from Facebook, I know where I usually vote, but now we have early voting in New York State. What you're offering, will this help me find where I go to early vote? Because it's not the same place.
Yeah, so the Voting Information Center is a key part of the broader strategy here. We're running the largest voter information campaign in American history. Our goal is to get 4 million people registered to vote. The voting information centers, which are going to show up on Facebook and on Instagram, will provide accurate and current information about where to vote, how to vote, whether that's early voting or day of voting. Also information about how to register to vote, how to confirm that you're registered, information about vote by mail, how to request an absentee ballot, and to provide this information right at the top of your newsfeed and linked to posts that talk about voting so that people can find this information quickly and accurately. That's the goal of the initiative.
Nathaniel Gleischer is the head of security policy at Facebook. We appreciate your updating us on all that you are doing at Facebook. We're going to turn our attention, though, to DraftKings because they were out with their earnings earlier, and there's a lot to digest here. There was a loss, $161.4 million, but revenue coming in at more than $74 million, despite what's going on with the limited sports calendar. So we welcome into the stream right now DraftKings CEO, Jason Robins. Good to have you here. What do you want sports fans to know about where we're headed and where you're headed?
Well, first of all, on the numbers, we were very happy that we had a very strong revenue quarter, ended up handily beating consensus and at the top end of our guidance. On the losses side, I think it's important for people to remember that we had a transaction to go public that we closed in Q2, and the majority of those losses are related to one-time transaction expenses as well as non-cash accruals. If you look at our adjusted EBITDA, which is more of a true reflection of the performance of the company, it's actually right on consensus. So I just wanted to make that note. As far as what fans should expect, we have a really, really exciting calendar of promotions and other sorts of events that we're putting on to celebrate, both the return that's happening now of Major League Baseball, NBA, NHL, to continue to, promote the golf tournaments that the PGA Tour and others are putting on. We're very excited that we're going to have the Masters this fall. And then, of course, most importantly, the start of the NFL season. We have $100 million that we are giving away to start the NFL season. All you have to do is go enter a completely free-to-play Survivor contest for week 1, and you will unlock your gift, which is anywhere from $5,000 to $25,000, and then we will have one lucky customer who wins $1 million simply by entering that free contest. So very excited to be doing that, and looking forward to giving away that $100 million.
Jason, Dan Roberts here. Thanks for coming back on.
Hey, Dan.
You talk about how excited you guys are for the NFL season. That's always so important for you. But we are following closely the mess in college football. Now, obviously, a little bit of a different scenario there, but what if there isn't an NFL season? How bad would that be for you guys? How would you go about weathering that?
Well, certainly it would have a short-term impact to our revenues, but we have over $1.2 billion of cash on the balance sheet. In some ways, it's actually, helpful to us if maybe some of the lesser capitalized competition that won't be able to weather it as well have to go through something like that while we are. Obviously, we don't hope for that. We want to see the NFL season occur and get played as planned. And I actually think, given how much effort I know has been put in by so many smart people at the NFL, and they've had their whole offseason really to plan for this, that we feel pretty good that the right plans and safety measures are in place. But we'll kind of roll with whatever's thrown our way. Obviously, we are hoping for NFL and think it could lead to really huge numbers for us. But if it doesn't happen, then it doesn't change anything about our long-term perspective and confidence and conviction in this market and what we're going to see over the next several years, not the next several months.
And then while we have you, got to get your take on this story about the IRS wanting to tax fantasy fees that you guys rake. And interestingly, it sounds like the IRS wants to brand those or label those as wagers. I saw somewhere that you said you believe their analysis is flawed. What's the story there, and how are you guys going to respond?
Well, listen, this isn't the first time that there's been an education process to help sort of explain the skill-based nature of the game and why DFS entry fees are distinct from wagers. And we do believe that upon sort of embarking on that education process, that it will become clear. And this is an issue, as you know, Dan, that's been for dozens and dozens of state legislatures and courts around the country already considered over the past several years, and almost unanimously have come out on the side that DFS is clearly not wagering; it is clearly skill-based. So we feel pretty good in that position, and we think that given the time and opportunity to explain and educate, that others will see it the same way. And it's really all part of the process. So we're looking forward to having an opportunity to make that argument, and we believe the facts and data pretty strongly support it.
Hey, Jason, it's Julie here. I want to go back to the issue of what sports are being played and what sports are not, and what might happen in the fall. Let's say the NFL season starts as normal, everything's fine, and then people start getting sick and they have to start canceling games. What happens to tournaments when all of a sudden you're in it and then games start getting canceled, or maybe the whole season gets canceled?
Well, one of the nice things about daily fantasy sports is that, the games last a day, or in the case of NFL, sometimes a weekend, but that allows us to be very fluid in the contests we post, and we can react to those things, as more news would come out. Obviously, we all hope that that doesn't happen and that there, are no cancellations or postponements. And as I mentioned, I do believe that a lot of very smart people at the NFL have put a lot of time and effort into making sure that there are safe and secure ways to play this season. But we're prepared either way, and the nature of our product being daily fantasy sports and betting, really allows us to, unlike a season-long fantasy sports product, really allows us to sort of react game to game, week to week to what's happening.
Jason, let's end by talking about competition. The whole gaming space has really, really grown in the last few months. Interestingly, a lot of those gaming stocks, including you guys after you became public, Penn Gaming, which now owns the majority of Barstool Sports, Flutter, the company that owns FanDuel, a lot of those gaming stocks did very well, even while there were not sports going on. And just yesterday on one of our shows, we were discussing an upgrade to Penn Gaming on the basis, this is of course just based on one bank's analysis, that Barstool Sports could start offering betting products. Where do you stand on sort of the competition outlook right now? Is that an issue for you guys? Are they now a competitor for you guys, Barstool, simply because of the Penn Gaming connection? And along with all that, is the betting now a bigger part of your business revenue-wise than fantasy, or is fantasy still the bulk for now?
So first of all, we're extremely excited that there's been so much focus from so many great companies. Penn and Barstool have very smart management teams, and the fact that they, along with IAC and others, have so much faith and conviction that this is an industry that will develop into a multi-billion-dollar opportunity, that excites us, and it helps validate, the hypothesis that we had. We also think that having more and more, well-capitalized, influential partners that are interested in seeing more states adopt online sports betting and potentially iGaming is a very good thing for us. And that, more than anything, is going to drive our growth opportunity. As far as right now, we do not disclose revenues by different products. So, can't really comment on the relative size. But I think the last time we spoke about it last quarter, I did mention that daily fantasy sports was still the largest part of our business. And As you can imagine, with COVID, it's kind of hard to say whether that has or hasn't changed since the whole environment in sports is kind of getting back to a more steady state position. But daily fantasy sports is our core. It's where most customers around the nation continue to engage with us, and it's a product we're going to continue to invest in and are excited about growing over the years.
DraftKings CEO Jason Robins, thank you very much, and all the best to the team at DraftKings. When we come back, we're going to hit something a lot of people are talking about, the payroll tax. Welcome back to Yahoo Finance. News on the move. Palestinians are protesting the historic deal to normalize relations between Israel and the United Arab Emirates. Israel agreed to not annex the West Bank as part of the deal, which is its third peace treaty with an Arab country. President Trump, whose administration brokered the agreement, called it huge. White House advisor Jared Kushner's hinted that other Arab states could follow the UAE's path.
The Justice Department says Yale University illegally discriminates against white and Asian American applicants following a 2-year investigation. The DOJ said the university must immediately stop using race or national origin as a factor in admissions. For its part, Yale said it will not change its admissions practices, quote, on the basis of such a meritless, hasty accusation.
Michael Cohen released a foreword from his upcoming book, Disloyal, accusing Donald Trump of visiting Las Vegas sex clubs and knowingly committing tax fraud. Cohen is Trump's former personal attorney, and he also writes, quote, I knew that the Mueller investigation was not a witch hunt. Trump had cheated in the election with Russian cheated with Russia. Trump had colluded with Russians, but not in the sophisticated ways imagined by his detractors. It's time for Yahoo You, and President Donald Trump signed an executive order last weekend enacting a payroll tax cut for Americans. So what should workers expect to see on their pay stubs? And will it really help jolt the U.S. economy? Yahoo Finance's Brian Chung is here to explain in this week's Yahoo You, and you never get tongue-tied, do you?
Not at all, Adam. Well, class is in session, and it's been said before that what goes around comes back around, and that certainly applies to even boring things like the payroll tax cuts. So let's unpack obviously all of this based on the executive order that President Trump put into effect over the weekend. And the order is really going along these guidelines here. So it's targeting specifically the Social Security tax, which comes out of every American's paycheck. And the tax holiday is effective for the period September 1st through December 31st, the end of the year. So you'll really start to see these effects beginning in a few weeks. Now, notably, this is not going to cover every American. It's only going to cover those that are making less than $104,000 per year. So if you make more than, say, $4,000 biweekly, you're not going to be affected by this change. So here's an example pay stub. And when your employer pays you, they'll detail your gross salary, and you should be familiar with what this looks like on your paycheck. At the federal level, Americans will pay these types of taxes, right? Federal withholding, Social Security, federal Medicare. So the executive order that President Trump put into effect over the weekend really targets this one here, Social Security. Now, the most important thing is that if this disappears over that period through the end of the year, it's going to be temporary. The taxes saved through December will eventually have to be paid back at some point because this is a temporary deferral. That is, unless President Trump wins re-election. That's because he said when he announced this over the weekend, quote, after the election, on the assumption that it would be victorious for an administration that's done a great job, we will be ending that tax. We will be terminating that tax. So basically, there's no promise you won't eventually have to pay back the savings from this tax holiday. Now, we've seen this movie played out before if it is indeed temporary. If we rewind to 1992, President George H.W. Bush passed a very similar tax holiday. He also got around Congress by signing an executive order. This time, though, it's targeting the withholding tax change, whereas the Trump change is targeting, again, Social Security. But the premise is still basically the same. It's to stimulate the economy. And at the time, President Bush said, something tells me a number of taxpayers may take us up on this one. Now, the question is, did it really? If you look at a University of Michigan survey from a month afterwards in 1992, the answer is really, meh. So about 41% said they would use the money to spend. That's exactly what the government would want to do in this case. But another, let's say less than half, about 44%, said they really planned to save it or pay down debt. So many even filed with the IRS to say, you know what, don't even change the withholding. I don't want it. And this is what they have. This is what they've called the economic concept of Ricardian equivalence, the idea of not changing demand because of the expectation that, well, it's temporary, right? Uncle Sam is just going to come knocking later and ask for the money back. Now, later in the summer, the Congressional Budget Office confirmed this effect. It said the effect of the Bush tax cut was really only about half as powerful as originally estimated because people didn't go back into the economy and spend all of it. So let's apply what we learned from 1992 to the expectation for the 2020 tax cut put in place by President Trump here. Goldman Sachs estimates that if the government were collecting that Social Security tax through the end of the year, it would be about $275 billion. That's a pretty substantial amount of money. But again, if 1992 is a model, the real effect of that might only be about half. Now, this right here isn't even the biggest criticism. This is the number of unemployed Americans through this COVID crisis. And the latest number was 16.3 million Americans as of July. This is the amount of people that are out of work. And these are people that have no paychecks at all. So if this is a payroll tax deferral, this is going to have no impact on all these people that don't have jobs, which really emphasizes the need for other types of fiscal support to target this demographic. That would be extended unemployment insurance, for example, supporting businesses, which are really their employers. Those are things that have really been helpful to these people, not necessarily a payroll tax cut. So in summary, the key thing here is really that this isn't a tax cut. This is really a tax deferral. So it's important to not only look at your pay stubs through the end of this year, but also look at your pay stubs at the beginning of next year, where you might have to be paying back all those taxes and Social Security that you didn't pay through the end of this year. So as I mentioned, what goes around does eventually come back around. Adam, Julie?
Okay, Brian Chung, thank you. And when we come back, we'll check in on markets with Jared Blickery. You're watching Yahoo Finance on the move. Jared Blickery is watching stocks on the move. Some have helped push the Dow and S&P into the green.
Yeah, and we're seeing a bit of a reversal from where we were at the open. Tech and the FANG stocks no longer leading. Instead, we have energy, industrials, and financials, even real estate leading to the upside here. So let's take a look at the NASDAQ 100 heat map on the Wi-Fi Interactive. You see Apple is now down 1%, Facebook and Alphabet each off 0.5%. Tesla still maintaining some gains, up 1.5% or so, had been up about 3% towards the open. Looking at the biggest winners and losers, Applied Materials after announcing earnings is up 4.5%, followed by Take-Two, and then Comcast. To the downside, Baidu down 7%. That's after iQIYI is being investigated. Baidu is a big investor in iQIYI. JD also down about 2%. They're going to be releasing earnings Monday morning. Now let's take a look at our sectors. We do have industrials, real estate, and energy in the lead right now. And to the downside, we have utilities and tech. Adam?
Jared, thank you very much. More Yahoo Finance on the move right after this with Julie Hyman.
It is noon here in New York. We're 2.5 hours into the trading day. Stocks are mixed right now, even as we see near record highs for the major averages. The Dow right now is up to 0.1%. S&P little change, slightly to the upside, and the Nasdaq is down 0.33%. Prospects of a stimulus package are growing slimmer by the moment. Senators have left Washington without a deal. There's still no plans to restart those talks. Market prices might be caught in a tug of war, but will the optimists or the pessimists come out on top? For now, it's definitely the optimists. Plus, President Trump claims the suburban housewife, in his words, will be voting for him come November, while our Rick Newman thinks that is just a myth. Welcome to On the Move. I'm Julie Hyman, along with Adam Shapiro. Joining this hour on the panel will be Ines Ferre and Rick Newman. Let's get to more on what's going on in these markets here. As I say, kind of a sideways move that we're seeing in today's session as we consider the lack of stimulus agreement. And we also consider the economic data out today. Retail sales up 1.2% in July. That's the third straight monthly increase, although the magnitude of the gains has been moderated. We've just about reached the same level of retail sales that we were at before the pandemic. But what will happen with stimulus checks not arriving. Michael Kushma is joining us now. He is Morgan Stanley Investment Management Chief Investment Officer of Global Fixed Income. Michael, it's always good to talk to you. So we continue today, notwithstanding, today we're a little bit mixed, but we are seeing risk on generally in the markets here as we see the 10-year yield is nearly 0.7% here today. Do you think that that will be sustained? Do you think that the tug of war between the optimists and the pessimists, the optimists will continue to win out?
I think so in the short term at least. Obviously, the gridlock in Washington on the new stimulus package is a worry if they procrastinate too long on getting it done. It's been one of our core beliefs that they will agree to a package at some point of a reasonable size, and clearly that has been postponed in terms of implementation. But in terms of the optimists versus pessimists, clearly the news on vaccine possibilities as well as the decline in cases, infection cases in the United States is still high, but declining in several states is a optimistic development over time. Plus, we still have policy very supportive, monetary policy in particular, and we don't expect Treasury yields to rise very much from current levels. We don't think the Fed would be too much in favor of that, and they will make noises come September if, in fact, yields do move higher.
Are you concerned in any way, though, about inflation perhaps becoming an issue sooner than later? We've had guests say short term, don't worry, but a year, 2 years out, it does become an issue.
I think that's still the right attitude. That longer term, we do expect economies to recover with stimulus, with vaccines, and other therapeutic measures, and that will help the economy grow faster and cause demand to rise and inflation to rise, especially with the Fed, I think, remaining very supportive through the recovery phase 2021 into 2022. In the short term, I think inflation is definitely lower than it was before the pandemic, and it has bounced strongly recently in the Consumer Price Index report. But there's a lot of technical factors going on in calculating inflation, demand for various products. I think I'm not taking this seriously as a change in short-term trends. So we think inflation will stay lower than it was before the pandemic broke out through the middle of next year, probably until something happens more materially with aggregate demand and the economy recovering.
Hey, Michael, Rick Newman here. You did not mention the presidential election as part of your outlook. Is it possible that a Joe Biden victory is actually a fairly benign development for financial markets, whether it comes with Democratic control of the Senate or not?
Well, it's a good question. I think that the polls are suggesting he's in lead. Given what happened in 2016, I think it's premature to count that the Democrats are going to win or sweep Washington. And I think that Biden has come across as more of a centrist. And I don't think right now, given the challenges the U.S. economy faces as well as the global economy faces, that macroeconomic policy will change that much. We need more stimulus from Washington on the fiscal side, and monetary policy is likely to stay easy going into next year. So that backbone of government influence in terms of actual spending and interest rates are likely to remain very supportive who either party wins.
Michael, one thing we haven't talked about is the high yield market. And I know that's an area that you are watching. You say default rates could easily hit 10% there. What are the implications there? I mean, not just for an investor who would potentially be investing in high yield, but in terms of any kind of ripple effect.
It's a very good question. Defaults have definitely been on the rise this year after being very subdued for a number of years, probing near all-time lows for the last couple of years prior to this year. And the problems which are faced by several industries, the energy industry in the United States, the leisure industry, entertainment industry, hotels, retailing, have clearly led to name brand defaults and bankruptcies in recent months. And that's not likely to diminish in terms of the pressures on many sectors of the economy. But we think we're reaching the absolute nadir, the bottom of what's going on in the economy. And things should improve, albeit gradually in certain cases, but get better from here. And yes, it is possible default rates in aggregate will reach 10%, but they should remain very concentrated in certain industries like we've seen so far this year. We don't think it'll spill over more broadly to the economy, which would be worrisome if the economy did not recover such that other sectors in the economy, cable, communications, gaming, whatever else is in the high yield index, they suffer more challenges going forward. We do not think that's likely, but it is possible. So we do think the default rates are peaking, will peak somewhere between, call it 8 and 10% between now and year end. But that should be it if everything else falls into place. And more fiscal stimulus is one of those things which need to fall into place.
We'll see if they can get it done, even in September. Thank you, Michael. Good to talk to you. Michael Kushmez, Morgan Stanley Investment Management CIO of Global Fixed Income. Well, as we talked about, we had economic data here in the United States out this morning, but we also had economic data out of China. And there too, they reported retail sales. They've actually fell 1.1% in July. The forecast was for a 1/10 of a percentage point gain. Industrial output rose 4.8%, but that was below what was forecast. We bring in now somebody who knows a thing or two about China. That is Leland Miller. He is China Beige Book CEO. It's good to see you, Leland. You're joining us from Delaware. So how should we read these numbers? We've heard some analysts say that we should look to China almost as a template for what the U.S. trajectory could look like as we start to hopefully emerge from quarantine and from the worst of COVID. How are you reading the numbers?
I think there's something to that if we could believe the numbers coming out of China. Now, what I will say is the dynamic you're seeing, even in official numbers, is the same dynamic that we're seeing in China Beige Book numbers. You're seeing a supply side recovery. You're not seeing a recovery on the demand side. Consumption's still very low. The Chinese government has the ability to ramp up production, output, inventory. They can really get things moving by ordering factories to do that. You're not seeing the same kick on the demand side. And that doesn't mean we're not seeing a recovery. We are seeing things improve month to month, quarter to quarter, not year on year yet. But we are seeing somewhat of a recovery. But it's important to understand that this is not the same return to growth that we've, that is being advertised in the year on year growth figures. It's a supply side recovery. It's not a demand side recovery yet. So it's better than other places, but it's not great yet.
Leland, it's not a metric from the Chinese government, and we've cited it twice this week already. Marriott, in their earnings report, talked about the fact that occupancy at their hotels in China up to about 60%, and year over year, it would have been about 70%. So the recovery is underway, they would say. Do you make anything of that? Does it indicate anything happening within mainland China with the economy?
Well, certainly China has been able to contain the outbreak far better than the United States and some others, and they got hit earlier. So the fact that there is a recovery in travel, to some extent, a recovery in hotels, these are positive signals. It's something that we definitely like to see. But this, you have to be careful about reading too much into this. You're not going to see the same thing happening in the United States. And quite frankly, that this is still a recovery that's building on the weakness of earlier this year. You're not seeing levels return to on-year growth just yet.
Leland, Ines here. What about the tensions between the U.S. and China with the recent executive order regarding WeChat, regarding TikTok, also the risk of Chinese companies being delisted? Would this have a significant impact on these Chinese companies? And what do you see there?
Well, not yet, because nothing that's been done is something that's going to hit Chinese companies in the short run, with the exception of a handful of very specific things, like if TikTok gets sold, or if WeChat is cracked down on, which I think is actually more unlikely than most. But I think most of the things you're seeing talked about right now are big bang changes to the structural relationship. So we'll delist companies over a 2-3 year time span. That's not going to affect them in the short term. But I think what we are seeing right now is we're on the edge of a dramatic ramp up in tensions between the U.S. and China right now. Going into election season, President Trump is going to be relying on the anti-China card to get back into this race. And so I think what you're about to see, whether it's a day, a couple of days from now, a couple of weeks from now, is a dramatic descent into a much more toxic relationship between the U.S. and China for the fall.
Hey, Leland, Rick Newman here. August 15th is the 6-month point at which there will be a review of the so-called Phase 1 trade deal. Can you back out from that a bit and just help our audience understand, has Trump accomplished anything with regard to trade in China? Has he been able to sell more U.S. products to China, or improve some of the trade abuses that most people understand with regard to China?
Well, you gave me a pretty low bar by saying, has he accomplished anything? Yeah, maybe he's accomplished something, but what he has not accomplished is a successful phase one deal. If you look at, the numbers came in last week. You've got the January to June data, so the first half of 2020, and there were targets that were supposed to be off, significant improvement off the 2017 baseline level, and they're nowhere near that. They're at about, in some cases, less than 25% of the target levels for 2020 in terms of purchases. So the deal by normal metrics is failing, and it's failing quite spectacularly by those metrics. The question then is, from a political standpoint, you do have COVID and you do have the election. So there's one built-in excuse, and there's one thing that might be an exacerbator of tensions. Where does the president come down on this? Does he want to keep the Chinese buying for as long as possible, or does he announce that, look, I had a deal, you didn't meet the commitments, and so we're backing out. Markets right now are convinced that Trump has to have this deal in order to make markets not go down. I think that's looking at it from the wrong direction. If he is going after China this fall, and he will be going after China this fall, particularly after the Biden campaign comes after him for being weak on China, it's going to be very difficult to stand by this deal. If your first priority is China, and first priority is trade, your second priority is China, how do you stand behind a deal that's failing by your own metrics? So this is going to become very, very difficult for the president to stand behind. But as of right now, he's backing it.
Leland, just briefly, give us the other side of that. What do you think the Chinese reaction will be in that case? Will they take a hard line? We have seen some rhetoric from them. We, of course, saw sanctions of U.S. senators as well.
I think the Chinese want to hide in a hole until November, let the rhetoric play out, see who they're going to have to deal with come 2021. And unless a handful of red lines are broken, I think that the Chinese reaction may be loud, but it won't be substantive. They're hoping that nothing serious happens beyond some loud rhetoric from Trump. I think they're going to be surprised. I think there's going to be enormous pressure to do some more things that are actually meaningful come September.
Leland, it's great to see you. Stay well. Leland Miller is China Beige Book CEO. Thank you very much. Just a bit of breaking news here. Rent the Runway has announced it's closing all of its stores. Actually, that's according to CNBC. It is going to keep Dropbox locations and add more of those. So it's not shutting the business, only the retail locations where people can go to try on its clothing. At the beginning of the pandemic, Rent the Runway laid off all of its retail employees, so that cut its costs considerably. We'll continue to track that developing story. We're also tracking a new initial public offering today. It just started trading a few moments ago, and the shares are off to the races. It's called Duck Creek Technologies. The shares opened at $42 after pricing at $27. They raised just over $400 million, I believe, in that IPO. So we are seeing a strong reaction in those shares. We are joined now by the CFO of that company, Vincent Chapari. He's joining us from Chicago. Vinny, I guess is what you go by, excuse me. So congratulations on the IPO, we should say. You guys make software that serves the property and casualty industry, and I believe you're started by insurance industry veterans. What does your software do, or what is it designed to do that you thought wasn't being done in this industry already?
Sure. So our software runs the core functions of a P&C insurance company. So the core of the system is policy administration, claims processing, and billing. And then we have other products that handle distribution management for their agents and things like that, reinsurance management programs, and data analytics. So really think about it running all of the core processes inside an insurance company.
Hey, and congratulations on the IPO. I just wanted to ask you, do I, as the consumer, notice that when your software is working with the insurance company? Because all of us have the horror stories of fighting the claims office. Does your software get involved in that process?
So sure, our software is actually used by a lot of the largest insurers in the world to process their claims. Our software, we deliver it as software as a service and a cloud-based solution. And we're one of our goals is to make the insurance industry more efficient by moving to more modern solutions.
Vinny Ines here. Given COVID-19 and the fact that everything has really gone digital, including insurance, what are some of your clients looking for as far as features? What are some of the trends that you are noticing with respect to your clients?
Well, we do have a feeling that the insurance industry wants to move rapidly to more agile solutions. So what they're looking for is the ability to launch products faster, launch different kind of products, be more reactive in the marketplace. Doing that with older style on-premise solutions has been difficult. So one of the things we're doing is bringing that to the cloud and enable them to be more agile in terms of how they run their business.
Vinny, you're the numbers guy, so I want to ask you about some of the numbers here. I know you guys have among the big insurers among your clients, Progressive, Liberty Mutual, AIG, Geico. Your revenue was about $153 million, if my information is correct, in the 9 months ended in the end of May. And here you are raising more than $400 million in your IPO. Like I said, the shares are going way up today. Did you price the IPO correctly? And now you've got a pretty high price to sales ratio, given that trailing 9 month sales number.
We do. I mean, we think we priced the IPO properly. It's easy to get excited about the first day of trading reactions. We're a lot more focused on long-term shareholder value and value creation, and we think we've got a good long-term story and expect to have really good sustainable growth for an extended period of time. We do think the industry is in the early stages of transition of their technology transitions, so we think there's a lot of runway here in terms of being able to grow.
Hey, Vinny, Rick Newman here. I have a question about climate change. So there's a lot of anecdotal reporting about more violent weather, more flooding, more storms, more fires, and things like that. If this is actually happening, one would think it would show up in property and casualty claims. Is that actually happening? Are you seeing an increase in claims over time that can be attributed to changes in weather and climate?
Well, catastrophic events come in waves and cycles, right? So, of late, I don't think we've seen any notable uptick in claims. Actually, claims volumes during COVID-19 have actually probably been down a little bit overall. But certainly the insurance industry overall is in a healthy condition and has weathered COVID-19 in a very strong fashion. It's a very resilient industry.
Would you expect your business to grow as, on this climate issue, as claims for weather-related damage and insurance companies have to take on greater roles in that? Or would you be susceptible to companies making the decision, we're no longer going to cover those kinds of issues?
Well, the way we price our products is as a function of the written premium that the insurers get. And we think about it in terms of the premium in the world. There's over $2 trillion of written premium globally, and that number increases every year. So even though a company may move in or out of one particular line of insurance, the way our products work and run almost on an enterprise basis for the most part, we're pretty insulated against any individual kind of movement.
And what are you looking to do with the capital that's raised? What type of expansion are you looking at?
Sure. So we have aggressive growth plans. We continue to invest a lot of money in R&D in terms of developing our products further, invest in our go-to-market operations, our sales and marketing organization. And one of the things we're doing in particular, we want to do some international expansion. And then we'll look at further acquisitions. We've done a few acquisitions in the last few years, looking to acquire companies that have product capabilities that add on to our existing core set.
Vinny, thank you so much, and congratulations again, Duck Creek CFO Vinny Chippari. Appreciate it. Well, I want to bring you a couple of stocks that are on the move right now that we have been watching. One of them is Applied Materials, the largest maker of semiconductor making equipment. That company came out with earnings that beat estimates both on the top and on the bottom line. And its forecast for fourth quarter revenue, its fiscal fourth quarter revenue, also coming in ahead of what analysts had been anticipating. The CEO said semiconductor equipment demand is strengthening. And based on what we're hearing from our customers, we believe growth will be sustained in 2021. Investors like this news. They're bidding up the shares by a little more than 4% today. We are also watching shares of Baidu, the Chinese company. Second quarter revenue, they're falling 1%, which is a smaller drop than estimated. And revenue from online marketing services not doing so great. It's down 8% last quarter. They did forecast third quarter revenue in line with estimates. But what's going on here with the 7% drop in the stock is that it still has a majority share in a company called iQIYI, which is now being investigated by the Securities and Exchange Commission. We will have much more detail on what exactly is going on with that investigation next. As we were talking about earlier, we're seeing a mixed picture for stocks today, but there's some interesting individual movers. Inez Ferre is watching all of that for us. Inez, what do you got?
We're watching right now Tesla up more than 1.5%. It was raised to neutral at Bank of America from underperform, with the analysts there citing unfettered access to low-cost capital, which remains a key advantage that may and should be leveraged to accelerate growth. Now, year to date, this stock is up 294%. Of course, Tesla recently announcing a 5-for-1 split. Also, Morgan Stanley, this analyst Adam Jonas, upgraded Tesla as well to underweight, from underweight actually to equal weight, and also putting a price target of $13.60 on the stock. All, of course, ahead of that 5-for-1 stock split that's expected at the end of August. Then just taking a look at Eastman Kodak, that stock is under pressure, down more than 9%. Kodak being hit with its first class action lawsuit over the company's initial stock jump after reports that it would be receiving a loan to make ingredients for COVID-19 drugs. Now, at issue here is, of course, is the timing of when the company indicated a loan was coming, what happened to that stock prior to the loan being officially announced. And of course, the loan is on hold until allegations against the company are cleared up. But you had seen what had happened with the stock when that loan had been announced the day before. Also, lots of questions surrounding that, Julie.
Yes, there are. In fact, we had the CEO of the company on the day after that loan was announced and asked him about that activity at the time. We also want to talk about, speaking of various investigations, I just mentioned a few moments ago, the company in which Baidu owns a majority stake is called iQIYI. It's been called the Netflix of China, and now the Securities and Exchange Commission is investigating it. It was sort of sparked by a researcher's report on this, of a company called Wolfpack that made allegations against the company earlier in the year. Inez, the stock is down quite a bit since this news of the SEC investigation came out. What's at the center of these various allegations here?
It's basically that Wolfpack had put out this research, and Muddy Waters had also shorted the stock back in April, saying that, basically calling this a fraud, saying that the company has overstated its numbers, saying that it's inflated user numbers and also its revenue. So the SEC probe actually cites some of the acquisitions and investments that were in this Wolfpack research, and iQIYI is saying that it's cooperating with the SEC, but it's not really giving a time frame or what kind of impact this kind of investigation or probe will have on the company. Now, Jefferies is keeping its bullish rating on the stock. It's keeping a buy on it, saying that this near-term headwinds don't change the long-term story. But I will tell you that it comes at an interesting time of when there are rising tensions between the U.S. and China, where there's this risk that people are talking about of whether Chinese companies may be delisted here in the U.S. And of course, also you had the situation with Luckin, which had Muddy Waters shorting Luckin over what its allegations of fraud, and then what happened with its own investigation with Luckin, and subsequently the delisting of that stock. So this will be something that will be paid attention to definitely over the coming months. Right now, the stock is down 15%. iQIYI had reported its quarterly results, but it's all really getting overshadowed over this SEC investigation.
Yeah, it's interesting to me. You brought up Luckin, right? And that was the other sort of spectacular blow up, if you will, based on accounting allegations. It's also interesting that it's Wolfpack and not Muddy Waters in this particular case, because Muddy Waters, Carson Block's short selling research firm, has been active on this front for years, trying to sniff out what Carson says are accounting irregularities in various Chinese companies. Sino-Forest is another that comes to mind that has been among his targets and that have ended up sort of crumbling as a result. So it'll be interesting to see what happens this time around, and if there are more of these types of issues that will come up going forward. Adam, I know that you're looking at this also in the sort of wider context.
Yeah, I mean, when you talk about a Cold War, if that's even the appropriate term, you've got news out of the Jerusalem Post that the United States and Israel close to signing a memorandum of understanding that Israel would not use Chinese equipment as that country builds out its 5G networks. We have For instance, India also taking steps against TikTok. So you got to wonder, are the allies aligning pro-US, pro-China, and how that's going to play out? I mean, Rick, you understand the politics of these kinds of things. It's as if the world is readjusting to the new war.
Sure, but let's go back to these companies. It sounds as if it's worth keeping in mind that these companies we're talking about, Luckin and now iQIYI, did I say that right, Julie? iQIYI, the Netflix of China, that these are actually real, these are not fraudulent businesses. These are real businesses that sound as if they are inflating their numbers. And this is not a Chinese phenomenon. We've certainly had companies here in the United States that have done this. Remember General Electric back in the Jack Welch era? The way they smoothed their earnings. Some people thought they were always pulling sales to or from the last or the next quarter just to keep things going, and they were very artful at it. But we've certainly had other companies in the United States that have done that. So it sounds like a financial discipline issue that I don't know where the enforcement needs to come from here. But short sellers and activists getting on the case of these companies are definitely a good thing. So maybe we'll see more of that from the likes of Wolfpack and Muddy Waters and some others.
I have a feeling we will. All right, guys. Well, we have to take a break here, but when we come back, we are going to be talking about representation and ownership in the music industry and also talk about a new docuseries. We'll be joined by Master P next. Welcome back to On the Move on Yahoo Finance. Well, tied to the Black Lives Matter movement, there has been a lot of reflection and reckoning in the music industry about whether Black creatives have gotten their due, and like in many industries as well, about minority representation at the executive level. Master P was one of the first Black music industry moguls, and a new series on BET called The No Limit Chronicles looks at how he built his record label in the early 90s. Master P, Percy Miller, is joining us now. It's good to see you again. And so this docuseries looks at how you built No Limit.
Yes.
And I guess you've been reflecting upon your experience as a result of that. What sort of stands out to you about how you built it and maybe how things have or have not changed in the industry?
Well, the struggle and the pain coming from poverty and not giving up. That's the message I want for this docuseries. I also want people to understand that the devil is real, and the only way you can stop the devil is keep going. We losing so many kids, not just from COVID-19 and the pandemic, but just senseless killings and murders. And I want to reflect on that. Black Lives Matter, but also Our Kids Matter, which is OKM. We just lost a kid in Compton that was 6'7". Could have been the next LeBron James, could have been the next James Harden. James Harden played for that program. And my thing is, like, we have to stop killing us. These senseless killings is hurting our community, our culture, our future. This kid name was Samaje Miller. This kid could have been the next big superstar. And you're gonna see throughout my documentary all the different things I had to duck and dodge to survive. We have to make sure education for these kids, they have the proper education. As parents, we gotta spend time with these kids. And coaches, we have to hold ourselves accountable. I mean, in the community, they call me Coach P because of, you know, me loving and being there for the kids in the community. And I think it's not about money. We have to have compassion for the next generation. And so that's my message to the world, that Black Lives Matter, but also our kids matter. They are our future. And that's what I want people to get out of this, because if I died at a young age, you would never be able to see my greatness and how I was able to change. None of us are perfect. Same thing like these kids. This kid died at 14 years old. We'll never be able to see his greatness. 6'7" at 14 with a 16 shoe. I mean, this should be in every community. We should be screaming, our kids matter. This kid deserves to have a full life, because these kids are the ones that are gonna come back and take care of the community. My heart and love go out to his family, the people in the community in Compton. I mean, DeMar DeRozan, I've raised him in that same community. I've been back there 22 years, and to just watch kids just constantly keep dying like this, I feel like this documentary is so necessary, so we could send that message to the world that we need to preserve our future.
Adam, I believe you're muted, my friend.
Mr. Miller, isn't this message, though, crucially connected to the other message of Black ownership and in greater just music? It has to be greater than just that. So how do we get more Black ownership of companies, not representation on boards, but actual ownership and power, control?
Well, we have to give African-American business people opportunity, the same opportunity that we given to white business owners. When you look at putting product on shelves, like in the Walmarts, the Targets, the Krogers, we have product, packaged food products. Me and my partner, James Lindsay, we have the Icon noodles, we have the Wrap Snacks, we have the Uncle P rice, Uncle P pancake syrup. So you're taking those products that was marketed off the shelves. Now we have to replace it with somebody that's gonna help, that's gonna give back to the community. The more we make, the more we give. Those shelving spaces, when that open up, we have to put people that look like us, that want to give back to the community. This is the only way we're going to change the injustice that's going on. If we want equality, we have some of the greatest products and brands, but we don't own them. So when you look at even the CEOs, it's only 0.5% of African-American CEOs. So we're not even just talking about owners, we're talking about Fortune 500 companies. We have to change that narrative. The only way we could change that and save our kids in our community, buy our blocks back and stop burning them down, is through ownership and creating that equal opportunity for African-American company owners, the same as other cultures.
Hey, Master P, Rick Newman here. I have a 21-year-old son, huge hip hop fan, does a little rapping on his own. Yes. And every couple of months, he's telling me about the death of another young rapper, Juice WRLD, yes. Obviously a big loss. And my question is whether there is not a kind of fatalism in the music itself that might contribute to the loss of all of these musicians. It's almost as if they don't expect to make it to 30 years old.
Yeah, well, I think we have to look at the music industry in music, because you even got guys getting convicted for their lyrics and people are dying young, but it's all entertainment. It's the same way we watch Scarface, the movie. We know that Al Pacino is gonna go home with his family. Same thing in the music business. I think we stereotype in that, but what we gotta look at the big picture, because now as we protest as whites, Black, Asian, Latinos, we're coming together as unity. Same thing in entertainment and music. We all coming together. So I think, as parents, we just got to spend time with our kids and tell them what's right or wrong. And I think that's where the change is going to come in. Even when you look at the kid that we lost in Compton, we have to hold the parents accountable for spending time with their kids. When you look at my documentary, my grandfather used to walk me through the hood. That's because he wanted to preserve me, made sure that I went to a good school. So those type of things we're gonna have to do for our kids if we want a better America. And when you look at African-American business, like my thing is all cops are not bad. All people in the hood is not bad either. So we're gonna have to take the bad cops, and they need to be incarcerated for the Breonna Taylors, the George Floyds, the good ones. We need to be celebrated. Same thing with bad people. If bad people do something in the community, they need to go to prison. And I just think the good ones we need to celebrate. And I think that's the changes that we're gonna make. When you look at in office, we need to start hiring some African-American judges. We look at politicians, we need to put the right African-American politicians in there, and we need to vote. We need to take out our power and vote the right people in there that are gonna make the difference for us.
It's good to see you again. Master P, aka Percy Miller. That new docuseries on BET is called No Limit Chronicles, about the building of No Limit. Thank you so much. Good to see you. We'll be right back.
Thank you guys for having me.
Thanks. This month, we mark the 100th anniversary of the passage of the 19th Amendment, giving women the right to vote. And there is a lot to celebrate, I would say, as well, especially with Kamala Harris being added to the ticket with Joe Biden from a gender perspective. Let's talk to Deborah Turner now. She is the League of Women Voters of the U.S. President. She's joining us from Omaha, Nebraska, and it's all part of our Women in Money series brought to you by USAA. Deborah, it is great to see you. Thank you for joining us. It's been 100 years since women got the right to vote. I'm curious about how we're using it as women. In other words, when you look at the percentage of women who vote versus men, when you look at accessibility for women who also, in many cases, have a lot on their plate, how do you think we're doing on that front?
Well, first of all, thank you for having me, and it's exciting to be here to talk about this issue. And as you may know, the theme for the League this year is that women power the vote. And it's really important to understand that women have been voting in significant numbers for a long time. And in fact, if you look back historically, more women have voted in presidential elections since 1980 than men have. And actually in last year, in 2018, there were 10 million more women actually registered to vote in America than there were men. And the turnout was greater for women. So we are truly powering the vote, and we are speaking with our voices. The problem that we had issued from the beginning, the time that we actually gained the right to vote, we're not given the right to vote, but gained the right to vote, was that initially in 1920, all women did not have access. And it wasn't until 1965 that many groups, particularly Black women and women of color in many areas of the country, were able to actually exercise that right. And they've been exercising it fiercely since that time.
Still muted. Ms. Turner, I think it's amazing for a lot of us that we live in a period where there's still an active effort to disenfranchise people from the vote. And we know about the headlines to deal with those issues. But what about, for instance, New York State? It's one thing to have absentee mail-in ballots, but it was a travesty, the counting, the way that they couldn't count ballots here. What needs to happen behind the scenes to get the 50 states and the election offices, because it's all different, up to speed for the current era in which we live?
There are a couple things that need to happen. One, first of all, the public has to recognize that this is a problem so that they can reach out to their elected officials who make these decisions, or their voting representatives, or their elections commissions within their states, within their counties, within their cities. The other thing is that we have, the country, have to decide that voting is such a critical part of democracy. Because let's face it, that's what a democracy means. One person, one vote. It's your vote that counts. That's your voice in your government. And we have to be willing to put the money behind voting. We have to be able to fund voting machinery. We have to be able to fund voting election commissions. We have to be able to fund the U.S. Post Office. We need to do the things that help the vote to move forward. And until we are really committed to that, there are going to be many people who continue to be disenfranchised when it comes to voting in our country. And that's what the League works for. We work continually doing this. We have been involved in many situations in multiple states around voter suppression issues, around within litigation and advocacy, and voter education, which is one of our really, really strong suits.
Hey, Deborah, Rick Newman here. So let me put that in the context of what seems to be happening for real in the election we're in right now. I mean, President Trump has all but said that he opposes mail-in voting because he thinks more people would vote. So what's your level of concern about that, and other evidence that, I mean, I don't mean to make this partisan, but it really does seem to be the Republican Party that is trying to keep some people from voting, especially in minority communities. What is your level of concern about that?
Well, like many organizations around the country, we are always concerned about voter suppression, no matter what form it comes in, be it closing polling sites, requiring more restrictions for people to actually register. And we are concerned about what is happening around mail-in voting. Our message is that at this point in our country, there is no clear evidence that there is any significant fraud within our mail-in voting system. There are many states that have been using this successfully for years and years. I myself have mailed-in voted many times, and that we have to educate the public to understand this is a safe and non-fraudulent way of voting. The idea that we should require, however, any voter to vote in a very specific way is also it's against the League. We feel that voters should have the opportunity to vote in the way that they feel most comfortable. So if you want to mail in your vote, that's fine. You want to vote early, that's fine. If you want to go to the polls, that's fine. We need to find ways to make that accessible for everybody.
Deborah Inez here. I know that the League doesn't necessarily endorse candidates, but you do support women running for office at every level. And given that Kamala Harris has been picked for the VP slot to run with Joe Biden, I'm just curious on your thoughts on how the U.S. has progressed, so to speak, or not, with respect to women reaching these levels? I mean, we did have Hillary Clinton that had run for president, but as far as when you compare it to other countries, I'm originally from Argentina. We've had a woman president. Chile has had a woman president. Do you think that the U.S. has lagged when it comes to those posts?
I would be untruthful if I said we haven't lagged. Okay. And the league works continually to get women to run for office at all levels, from their local communities to the highest levels of government. And we also encourage women to be involved in everything from commissions to committees to whatever is part of their civic structure within their community. We have lagged somewhat in the United States. It is kind of amazing that in the year 2020, we haven't had a woman as president of this country. As you know, many countries have, but we see there's a future for this. And the fact of having a woman of color actually being part of the ballot for the one of the highest offices in the country is absolutely fantastic. However, being the first is really great, but the goal is not to be the first. It is not to be the last. And so we will continue to fight to elevate the voices of women in elected positions, and also to elevate the voices of women of color in elected positions. Because until we have the day where our elected officials and our positions of power reflect what our country looks like, we still have a ways to go. We know that, but we're fighting for it. And there are many across the country who are joining us in this fight.
Deborah, one final quick question when it comes to voter accessibility and getting the elected officials to look more like America. Does there need to be a national holiday for Election Day?
That obviously is a very controversial topic.
I don't know why, to be honest, but
granted, many people have looked at that to determine would it increase voter turnout, would it not increase voter turnout? It would be, I think, a wonderful thing to happen. We have not, particularly at this point at the league, engaged in, a campaign for this, because there are so many other things on our plate that we're dealing around voter education and voter registration and get out the vote. But this is something that will probably be discussed in the future and may very well be something that comes in the future. So we have to wait and see.
Deborah Turner, thank you so much for your time. League of Women Voters of the U.S. President. Appreciate very much.
Thank you.
We'll be right back. It's time for Word on the Street, where we check in with our panelists, find out what stories they are watching. Rick is actually watching a myth, the myth of the suburban housewife, who President Trump says will be putting him over the top in November.
Here's Trump's pitch to what he calls the suburban housewife. They're all going to vote for him because what Trump is going to do is prevent low-income housing from coming to the suburbs, which means what he's saying is he is going to keep the suburbs white and make sure brown and black people don't move in. So that's enough. That's controversial enough. But I want to ask any married woman with kids out there who might be watching or might be on the panel or might even be one of the producers, Val, who might have feelings about this in the Hangout. Who thinks they're a housewife? Who considers themselves a housewife at this point? If you look at the actual demographic data, it's a tiny portion of American adults who are women with kids who stay at home and don't work for pay. At least 70% of women with kids do work. We've seen, obviously, women become a much larger point of the workforce over time. And Donald Trump, I call him 70s man because he likes tariffs, he likes beauty pageants, and he likes housewives.
Yeah, that definitely elicited some strong reactions in the Slack channel.
Do you consider yourself a housewife?
No, I'm a working mother. There we go. All right.
Housewives is so 1980s.
If not 50s. All right.
Yeah. Or 70s or 60s.
You're taking a look at what Amazon is offering to its employees, perhaps the chance to become suburban working moms.
Perhaps to move out of Seattle to smaller offices outside of Seattle. Amazon reportedly had asked its employees about options, perhaps Tacoma, Redmond, Washington, if they'd prefer. Now, Amazon has been talking about expanding itself outside of Seattle, really because of also tax issues. It's had a little bit of a rocky relationship with city officials in Seattle because of new taxes on big employers. So even before COVID-19, Amazon was looking at making more satellite offices. So this is just an acceleration of that because of this tax on big employers wanting to make it more attractive for employees to not have to commute into Seattle and to be able to go to somewhere else that's perhaps a little bit smaller. But this really brings into focus what will happen to cities as people are leaving cities so rapidly and going into suburban life and going into other places. What will happen to cities if businesses as well leave? And especially now at a time when cities need taxes.
Yes, this is something that we have been talking a lot about, although Seattle is sort of a more suburban city than many, right? I don't know how many people live in downtown Seattle proper who are working at Amazon, but nonetheless, there's definitely this sort of focus on quality of life with so many people who are now working from home. Inez Frey, thank you very much. Rick Newman, thank you, as always, for the spirited discussion. I'm sure the true suburban housewives will be tweeting at you in droves as a result.
I need one to clean up around here. I'm kidding. I'm kidding, America.
Thank you, Rick. Adam, thank you as always. Everyone, have a fantastic weekend. We've got a mixed picture for stocks. There is much more Yahoo Finance coming your way all afternoon. Stay tuned.
Welcome into live market coverage here on Yahoo Finance. You're watching the ticker. I'm Zach Guzman. Right now, we have a bit of a quiet day here on Wall Street to wrap up the week. A mixed bag. The Nasdaq just slightly in the red. The S&P and the Dow trading pretty much at break even here. And we have a bit of a mixed bag as well. And you look at the sectors performing inside the S&P 500 right now. Most in the green, but healthcare and utilities, the two as of right now at 1 p.m. Eastern time, trading in the red. And on that front, a few key standouts to highlight here, because we don't always get a triple in a debut, but we do have shares to highlight there, as CureVac is trading up more than 200% in its debut here after it priced at $16 a share. Bank of America, the lead on that deal, leaving just a bit on the table there. It looks like the German biotech firm backed by Microsoft founder Bill Gates is working on its own coronavirus vaccine. That makes this the first biotech company we've seen debut while also working on a potential coronavirus vaccine. It's dedicating most of its $213 million in the proceeds in this IPO towards those efforts. We'll chat that and the other vaccine makers that we're seeing make announcements here and pairing up with the UK later on in the show. But a big upside move there after pricing at 16, trading above $50 a share just a second ago. And also worth highlighting, shares of DraftKings today also under pressure, trading more than 6% to the downside earlier today, not only because of weak earnings, but also a new IRS memo threatening to tax wagers at the sports gaming company. One lawyer even told Bloomberg that the taxes that could be imposed could, quote, be potentially business destroying in some jurisdictions. The CEO there batting back at that a bit on Yahoo Finance just a moment ago, saying that it would be able to back up its case that contests there are not, in fact, pure gambling, but rather a skill-based game, making those contest fees able to skirt tax regulation. We shall see. Right now, investors not necessarily on his side. But meantime, we also got the update on new retail sales numbers coming out this morning, showing what we've already seen in a lot of the data we've been getting recently, which is a moderating recovery. Overall, in July, we got the 1.2% rise in terms of household spend on retail. That's considerably down from 8.4% in June. It could be adding pressure to the hopes of getting a fourth round of relief bill out of Washington, but talks right now remain stalled, with Congress officially entering its recess here, and not a lot of hope that any compromise is soon to be reached. And for more on those struggles, we kick off the show today with Stephanie Miller, Fiscal Note Markets Managing Director. And Stephanie, I mean, when you see Congress going on recess here, it's not generally a good sign. We know they could get called back here, but you're not optimistic we're going to get a deal because of this standoff right now till after Labor Day. So why do you think that is, as we see Republicans and Democrats continuing to not make any progress at all?
Yeah, so the real catalyst for a deal was the absence of help to Americans, the expiration of unemployment insurance that had been expanded under the first stimulus bill, the CARES Act, that expired at the end of July. So that expiration of that and payroll protection program, that PPP small business loan that expired on August 8th, those were the things catalyzing action. The president last weekend swooped in and said, you guys have been fighting too much, Congress. Like, no one trusts you to get anything done. No one really likes Congress anyway, because they never get anything done. And so he did 4 things unilaterally, and that including extending the unemployment insurance expanded benefits. So that really took a lot of the wind out of the sails of Congress. They were already not agreeing to things. This made the environment even less likely to see them agree. And so now they've gone home. And so I don't think they're going to be called back before Labor Day. I don't know if they couldn't get a deal before when the pressure was higher. I'm not sure how they could right now.
And that becomes an issue when we think about, the retail sales numbers, as I said, kind of echoing this moderating recovery. And you think about not only just those unemployment benefits rolling off, but also the hopes a lot of Americans had out there of getting this next wave of stimulus checks. We know that a lot of Americans there qualifying for a $1,200 stimulus check. And now the longer these talks take, I mean, that's one thing that even President Trump's executive orders wouldn't address here. So what's your take on that as maybe, devil's advocate, maybe that would apply some sort of political pressure here as Americans might get more angry at the idea of Congress taking recess now?
Yeah, I mean, I think the stimulus checks and the PPP, that small business lending program, those 2 things are going to be what keeps Congress at the table. And so whether or not all the other noise gets in the way, those two things, both Republicans and Democrats on Congress and in the White House agree need to happen. And so that, common ground is always the best place to start with compromise. And so, will there be pressure right now to catalyze a conversation before Labor Day? I'm not really sure that needs to happen. And there is a lot of other stuff, such as for Republicans having liability protections for businesses. For Democrats, it's sending $1 trillion to the states. These are no-goes for the other party. So I'm just not sure we can overcome those yet. But I do think more likely than not, another round of stimulus checks happens. I just think it's in September.
Yeah, and I mean, when we think about that flip side, if you're saying that that is where we are seeing compromise right now, or at least mutual agreement, on the flip side, you raise the state funding as an issue here as well. On that front, we got another estimate out from the Center on Budget and Policy Priorities saying that the overall gap there for state funding is roughly going to be more than $550 billion when we think about what states are going through. That's through fiscal year 2022. Obviously, Republicans and Democrats right now not even close to agreeing on that issue, but how important is it to solve when we think about the problems that not just state governments, but local governments are facing here too, trying to weather the storm?
I think even taking a step back, and the way I think about the answer to that question, and probably the reason why the market continues to chug along and do well, despite that a number of these economic indicators aren't as hot, is that there's a lot of confidence that whether it's via fiscal policy or monetary policy, there will be backstop money available. So it does seem like the states are facing shortfalls. The real political issue is whether things like pension funds or other obligations that Democratic members of Congress are really keen on filling, and that Republicans see as a political issue of not keeping your budgetary house in order and fixing that, whether those things can be overcome. But if a state is really facing dire straits because of COVID, I think the market expects, and probably rightly so, that some way or another money will be there for the states.
Yeah, and lastly here, I mean, we're talking about both sides kind of digging in, but it does seem like there are at least concessions being made on the extreme here. President Trump had taken issue with the idea of a Democratic proposal instituting funds for the United States Postal Service and whether or not that might interfere with the election. We've talked about how there doesn't seem to be any data that fraud would rise with more mail-in ballots, but on that front, he walked back his prior suggestions that he would block any deal that came through with more support for the USPS. How does that maybe shift discussions here, or maybe add any hope in your mind to the idea that maybe we wouldn't have to wait till Labor Day to get a deal?
Well, funding for the post office is obviously a big thing for Democrats from a number of perspectives, including the political election one. Interestingly, when Trump signed the 4 executive actions, he verbally said, that the Democrats, he was critical of the Democrats on the House, their proposal in stimulus, saying they were giving so much money to the post office because they are fraudulent, that the only way Democrats can win elections is if they cheat. So I think he's starting to get some of the political benefit around that rhetoric without maybe actually needing to do one thing or another on the funding side. So if he can come in and help facilitate a deal that helps save the economy while also keeping the flow for his voter base and others, potentially like starting to shed doubt in the minds of the electorate that if the Democrats win, it's because they cheated, then maybe he can have his cake and eat it too. And it seems like that's what he's trying to do.
We'll see how all these talks play out. But as you noted, with Congress going on recess, not a lot of hope right now that a deal will come through. But Stephanie Miller, Fiscal Note Markets Managing Director, appreciate you taking the time.
Thanks for having me.
All right. Well, when we look at the market action, again, trading flat right now, and trading volumes also should note about 30% below the 30-day average that we've seen here. And a lot of that might be due to the fact that we haven't gotten the updates out of Washington, D.C. on the current negotiations. But that doesn't stop some market analysts from saying that there could still be upside from here. One of those firms being Goldman Sachs, saying that there is room for the S&P 500 to surpass 3,600. Right now we're at about 3,373. And their bull case seems to be intact here if we could get a deal potentially, or also if there is progress on the vaccine front. And joining us now for more on what we're seeing in terms of the markets digesting the news as of late is Jeff Weiner, Markham LLP CEO. And Jeff, good to see you again. I mean, when we talk about that, obviously that would be about, from right here, about another 300-point rally to see the S&P get up there So, I mean, when we're talking about that, what's your thinking around if we could get back up to 3,600? And I don't know if we have your audio right now. I don't know if it's coming through. Might have to see if we can get that resolved here. Yeah, well, you know what? We'll just take a quick break. We'll address that in this break and come right back since I want to dig into it with you. Stay with us here on The Ticker. We'll be right back. Welcome back to live market coverage here on The Ticker. Of course, we got some more data points to digest here in terms of the slowing recovery. The latest there being U.S. household spending on retail rising 1.2% for the month of July, returning back to pre-pandemic levels as we see there, but notably much slower than the 8.4% clip we got back in June, raising a lot of questions about how this recovery might stall out, especially considering a lot of those unemployment benefits rolling off at the end of last month. And here to discuss that, as well as where the market could trade from here, is Jeff Weiner, Markham LLP CEO. Jeff, when we look at it, you might think that that would cause a reason here to take a little step back in the markets, yet the S&P 500 is sitting close to all-time highs here. And when we think about that, what's your take on how maybe the market still might be pricing in the idea that we could still get a deal rather quickly here out of Washington?
Well, I think the market has room to run up. I think one of the key things will be we'll probably test new highs if a vaccine or a therapeutic is developed. But you know, the stimulus package or lack thereof, and Congress going on recess is certainly not going to help the economy in the short term. It's not going to help retail sales. There's a lot of people who are relying on those extra $600 a week checks or supplements to actually put food on the table and go to stores and buy non-necessities. So while I think the market could test new highs, in the short term, it's going to be in a trading range.
Yeah, that's kind of interesting as to see why we got Goldman Sachs raising their target for if all goes well here, saying that the S&P 500 could reach 3,600, noting a couple things. One, improving prospects for an early vaccine, as well as what we're seeing play out right now in the bond market, the 10-year back up to 0.69, the yield there. I mean, what is your thought on that front? Because obviously there's a lot of optimism around vaccine research, but even what we hear out of Dr. Fauci is saying that, you know, rolling it out might take until the back half of 2021 to get it to most Americans. It still seems like a long way that we're going to see the unemployment rate and all these other economic indicators showing relative stress for the time being.
Well, Zach, you just said it, the 10 years at 0.69. If Goldman is right and the S&P can go from 3,300 to 3,600, that's about a 10% move. So if you have a choice, the real issue is there's no place else to put money. Fixed income yields are at almost historical lows. They're not attractive. Real estate is problematic, although multifamily has probably been the best place to have money in real estate, although we'll see what the effect of the $600 a month decrease that unemployed people are now getting has on multifamily. But when you really look at people with money to invest, if you can potentially get 10% in the next 6 months on your S&P investment, there's no place else that compares.
Mm-hmm. Yeah, I mean, what we've seen here, at least in the earnings season so far, is a lot of low expectations. So not necessarily difficult for a lot of these companies to top those expectations. But just one question out of what we saw in the retail report, because digging in a little bit further, when you look into the so-called control group there, the subset that excludes food services, car dealers, building materials, and gas, sometimes more looked at in terms of the underlying trend there, up 1.4% versus the prior month as well. That was better than expected. So, I mean, maybe there is some sort of strength here to think that the US consumer isn't necessarily in as bad a shape as some people fear. But obviously, so much of what happens with the economy hinges on those household shoulders here when we think about consumption, the main driver of the economy. So how important does that then make getting a deal ASAP out of Washington, D.C.? And why is the market not trading lower off of not getting one?
Well, it's twofold, Zach. First of all, I think you're seeing a generational shift in people's consumption habits. I know I've been at home or basically working from home for the last 5 months or so. My consumption habits have changed. I mean, if it wasn't for you today, I wouldn't be in this shirt and tie. So, my work clothes most days are gym shorts and a sweatshirt. So, I haven't been out buying new work shirts or ties or suits or shoes. And a lot of people are in the same boat. So I think, you mentioned car dealers, you mentioned food, the staples, the necessities, the stay-at-home necessities are really doing well. But we're also at the same time seeing a historical amount of retail bankruptcies. Every week you're reading about the latest major retailer to fall by the wayside, while Amazon is looking to snap up real estate that was formerly occupied by JCPenney and Sears. So we're seeing what I call a generational shift in what people are buying it, where they're buying it, how they're buying it, and non-essential retailers. And we can put food and gas and auto dealers into appliance manufacturers. We're selling more Apple TVs and flat screens today than we were pre-pandemic. So really a shift going on in what people are buying and where they're buying it. It's really accelerated that trend that Amazon started 20 years ago.
No, you're definitely not wrong. Electronics enjoyed quite the boost in the latest retail report there, jumping, 22.9% in electronics. It's a big boost. And on the flip side, seeing weakness in sporting goods and hobby stores, down 5%. But you're addressing kind of this split that we've been discussing on the show recently, which would be this tug of war between tech companies that necessarily haven't seen weakness, like the retail names you're mentioning, and cyclicals, some of those other ones out there when we think about, I don't know, cruise stocks or some of these airlines out there that notably are waiting on what other aid might come through here in this fourth phase. So, I mean, if you think about risks in the market right now, would it be too early to start thinking about some of those names like the airlines that might be tied to consumer sentiment here in the back half of 2020?
I don't know if it's too early. We may not have seen the worst of it yet, the longer this lasts. I know this is August. I'd typically be planning my Christmas vacation now. That's not even a thought. So I'm not buying airline tickets. I'm not making hotel reservations. People's patterns and consumption has changed. So I'm not sure that the travel and leisure industry has seen the worst yet. So if you want to take a macro bet, that industry is going to come back. On a micro level, I'd be a little skittish on picking exactly which companies are, you may have airlines going through bankruptcies in 6 months and holders may get wiped out. But so I'm a little skittish in jumping into individual names as a sector. there's probably some immediate downside risk, but long term, it will come back. I just don't know when.
Timing always one of those issues to discuss here, but we'll see. As we know, a lot of the aid to airlines rolling off at the end of the next month here, so we'll keep an eye on that. But Jeff Weiner, Markham LLP CEO, appreciate you taking the time.
Great seeing you, Zach. Take care.
Meantime, when we think about the fears around the coronavirus pandemic right now, we've been tracking cases in a lot of the worrying states, but worth noting that it's not only those states that we should be looking at here, as fears of a resurgence in New York are also there. We saw that play out in California, having to shut down again. Cases in that state topping more than 600,000 there. And for more on this and the way that the nation is grappling with it on every front, joining us now is Dr. Arabia Millett, emergency physician at the Brookdale Hospital Medical Center in Brooklyn, New York. And Dr. Millett, I mean, first off, we've gotten a lot of updates on the vaccine front, but I just want to play you a sound clip that we've seen in terms of both President Trump and now Democratic nominee Joe Biden talking about masks, since we've heard the update from the CDC there, saying that this could probably be over in the next 4 to 6 weeks. Not over, but marginally improved if everyone wore masks. Just want to play you a little bit of the political divide we're hearing right now. Take a listen.
Every single American should be wearing a mask when they're outside for the next 3 months at a minimum. This is America. Be a patriot.
It's a shameful situation for anybody to try and score political points while we're working to save lives and defeat the pandemic.
All right, so Dr. Millett, I mean, you heard both politicians speaking there. The CDC has said that the fall season will probably be the worst ever in the U.S. history for public health. So what's your take right now on how this is the time we should be preparing for the fall and how masks can play a role in that right now?
Well, first, I would like to say that we cannot put time on data or use data in a sense where we place in time when this coronavirus pandemic will cease. First of all, the numbers will continue to increase as long as the states do not shut down properly and do not mandate their citizens to wear masks. And that's the big problem. They haven't shut down properly in the first place, or haven't had restricted lockdowns, and they're not mandating their citizens to wear masks. Again, there's no timing when this pandemic is going to be over. So we're saying that 3 months at least, the minimum. I disagree with that. We just need to be wearing masks until we can find a cure or a safe, non-toxic vaccine to fight this pandemic.
Yeah, and the political divide is strange there too, since Trump's own CDC director, Robert Redfield, has talked about how masks do help. And then you hear the pushback from President Trump saying that Joe Biden is just scoring political points here for calling for a national mask mandate, saying that there's no way to enforce it. However, we know that governors can enforce it if they impose a mask mandate here. So I just don't really understand the discussions playing out right now on the masking front. But I'm not sure if there's any way to really explain it in a way that would prove why it's something that's so important right now.
To be honest with you, none of us understand. Those of us who are on the front lines, whether it was the former epicenter, which is New York. And remember, New York was hit the hardest back in March. From March to actually the end of April, or about mid to late April. And it did work. It helped brought our numbers down, not only just wearing masks, but we had the strictest lockdown in the entire country for approximately 15 weeks. And although it was hard initially for many New Yorkers, but New Yorkers had to pull in together to be able to bring our numbers down. And it wasn't just from the governmental side or the governmental level. It was almost every New Yorker had participated in bringing down our numbers and wearing masks, practicing physical distancing. We changed the term from social to physical distancing. And so I'm just not understanding what is the big deal of just promoting public health. Profits over public health has become a major issue in this country. When are we going to do away with that? I have no idea, but it cost so many lives of American citizens in this country and had devastated numerous communities throughout the United States.
And I mean, it's not to say you can't have both. I mean, we've seen it work in terms of wearing masks and having businesses reopen modified, albeit modified. But, we've seen outdoor eating resume here in New York. But I'm glad you mentioned what could happen here in New York, because there are a lot of fears that we would see a second wave, even though the case count has come down. Today, Governor Cuomo announcing that New York City museums will reopen starting next week with 25% occupancy. Bowling alleys coming back Monday with 50% occupancy. But we know that there are quarantine rules in effect here in New York to protect against that second resurgence. And I just want to read a little bit of a statement that we got from Governor Cuomo's office talking about right now whether or not New Yorkers are actually following quarantine procedure. And here's what they had to say. They said, quote, "Right now, overall, we have nearly 100% compliance because people who don't fill out the form get a summons and potentially a fine. We don't have data yet on how many people have not followed the quarantine, as this effort is done by the localities, which ensure compliance through interviews, phone calls, daily text messages, and random checks." Now, anecdotally, I have seen some people not following these quarantine rules coming back from some states and traveling around and not staying inside. So what's your take right now on how much effort and how much force is actually there? Because I don't know if we should really believe 100% compliance based on what we've seen here, but what does it say about how some of these states, New York included, might not have the power to actually enforce these things?
Well, I think New York does have, well, I'm not going to say that we have the power to influence these things, but one thing I would like to say is that the reason why we are able to reopen New York through various phases is because that we had followed and met the government's criteria for returning to or reopening the economy. And those two phases that we experienced were a 14-day downward trajectory of confirmed cases or documented cases. And we were able to take care of patients without critical care. And that was a big, big part of why we are able to move in that direction. It is not to say that the research cannot happen again, because as we see what's happened in New Zealand, a few days ago had 0 cases confirmed with coronavirus, but now they have a cluster and it actually increased to 14 cases. And now the country decided to go back into lockdown. So right now, there's no definitive answer. I think that we are going to do the right thing. I'm just speaking from New York, but the newer hotspots did not necessarily meet the criteria, first and foremost, did not have a complete lockdown. And children are now returning to schools in communities in which the virus spread is detrimental. And so this is the part that I'm really, really concerned about, because I just don't understand why can't we as a nation able to come together and put away our political differences, leave the politics out of it, and fight this pandemic.
That's something that I think a lot of us would hope to see. We're seeing more places go ahead and change their rules based off of the data coming in. We just saw Stanford go ahead and unfortunately let students know there that they might not be able to be invited back to campus because of what they're experiencing now. But Dr. Millett, appreciate you joining us to share your insight there, emergency physician at the Brookdale Hospital Medical Center in Brooklyn, New York. Thanks again and good luck.
Thank you.
We're going to take another break here on the ticker. When we return, digging into the way that banks continue to loan at lower than expected rates right now. We'll dig into the new numbers there from S&P Global Market Intelligence, as well as the secret player Joe Biden has recruited to his economic team. We'll reveal who that is right after this. Welcome back to live coverage here on the ticker. Want to show you the action we're seeing right now in CureVac shares. The triple burger is intact, ladies and gentlemen, on debut day, up more than 207% shares there in the German biotech firm backed by Microsoft founder Bill Gates, enjoying quite the pop on day one using those proceeds. They raised more than $213 million. The majority will be used on working on its mRNA vaccine for a cure here in battling coronavirus, and we will continue to watch shares rising there. Outside of the biotech and IPO action there that we're seeing, also worth taking a note at the banking activity. We've been discussing this on the ticker for the past week here.